Donald Trump was sworn in as the 47th President of the United States, and within an hour, the global economic order began to convulse. Less than 50 minutes after taking office, he signed his first executive order. Shortly after that, financial markets across the world started to slide. By the afternoon, emergency calls were underway between finance ministers on 3 continents. Within hours, Beijing issued its response. This is not retrospective analysis. These events are unfolding in real time. What we are witnessing is economic confrontation on a scale rarely seen, and the international response has been faster and more forceful than many expected. On his first day in office, Donald Trump initiated what can only be described as the most aggressive opening move in modern trade history. Retaliation is already underway. For anyone with investments, a mortgage, exposure to international trade, or employment tied to global supply chains, the next 72 hours are critical. Decisions taken during this window will have lasting consequences for household finances and economic stability. The first executive order was leaked to financial markets before it was formally signed. Officially titled Restoring American Economic Sovereignty and Fair Trade, it reads like standard bureaucratic language. In practice, it represents a dramatic escalation. The order imposed immediate tariffs of 60% on all Chinese imports. There was no phase-in period, no negotiation window, no exemptions. Every smartphone, laptop, garment, toy, and electronic component manufactured in China was suddenly subject to a substantial tax at the US border. The measures did not end there. A blanket 25% tariff was applied to all imports from the European Union, encompassing Germany, France, Italy, and every other member state. A further 20% tariff was imposed on all Mexican imports, in direct contradiction of the trade agreement Trump himself negotiated during his previous term. On top of that, a universal 10% baseline tariff was levied on imports from all remaining countries, including close allies such as Canada, Japan, and South Korea, accompanied by explicit threats of further increases should those nations retaliate. The scale of the impact is considerable. Economists estimate these measures amount to roughly $400 billion a year in new taxes on American consumers and businesses. This was not positioned as a bargaining tactic. This was policy implemented immediately on day one. Markets responded without hesitation. Major US indices fell sharply, with technology-heavy stocks leading the decline. European exchanges moved rapidly into freefall, followed by steep losses across Asian markets. In a matter of hours, more than $4 trillion in global market value was erased. Currency markets became volatile, commodity prices surged, and liquidity tightened. This was not ordinary market turbulence. It was a systemic shock. A second executive order followed soon after, this time directed at monetary policy. The president instructed the Treasury to coordinate closely with the Federal Reserve, introducing formal mechanisms for political influence over interest rate decisions. For more than a century, the Federal Reserve has operated with institutional independence. That convention was effectively challenged in a single stroke. The response from the Federal Reserve was swift and unequivocal, reaffirming its independence. Financial markets, however, reacted sharply. Bond yields rose, borrowing costs increased, mortgage rates jumped, and housing-related stocks fell heavily. A third executive order then turned attention to energy. American liquefied natural gas exports were explicitly tied to trade compliance, effectively weaponizing energy supply. European governments reacted with alarm, convening emergency meetings as the implications became clear. Energy stocks swung violently as investors assessed the impact of a widening trade conflict on global demand. China's response followed shortly thereafter. Officials announced countermeasures within 24 hours. These included plans to halt purchases of U.S. Treasury bonds, restrictions on rare earth exports, retaliatory tariffs on American agricultural goods, and threats to limit dollar-based transactions while seizing U.S. corporate assets operating in China. This was not a negotiating signal. It was a declaration of economic confrontation. The European Union soon followed suit. Emergency sessions were convened, counter-tariffs were prepared, formal complaints were lodged at the World Trade Organization. Coordination with China intensified, alongside renewed momentum toward deeper EU-China trade agreements. Measures targeting American technology firms were openly discussed. In a matter of hours, The foundations of the post-war transatlantic alliance showed visible signs of strain. European leaders responded with barely concealed anger. Berlin described the tariffs as a direct assault on the international rules-based economic order. Paris was even more explicit, stating that the United States had chosen economic nationalism over partnership. This was not routine diplomatic protest. It was a signal that America's closest allies felt blindsided and betrayed. Mexico moved quickly and decisively. Tariffs were announced on U.S. goods. Cooperation on border security was scaled back. Officials confirmed they were actively pursuing deeper trade relationships with Asia and Europe. The possibility of nationalizing American corporate assets operating in Mexico was openly discussed. The message from Mexico City was clear. Economic pain would be endured, but political submission was not an option. An emergency call between G7 finance ministers followed shortly after. Discussions centered on coordinated retaliation and, more significantly, on reducing reliance on dollar-dominated trade and financial systems. For Washington, this represents the most serious strategic risk of all. American financial power rests on the centrality of the dollar. Any concerted effort to weaken that position would have long-term consequences well beyond this immediate dispute. Meanwhile, the impact on the real economy began to surface almost immediately. Major retailers warned consumers of imminent price increases. Walmart led the way, quickly followed by Target, Amazon, and Best Buy. Tariffs are not absorbed in theory. They are paid in practice. Electronics, clothing, furniture, appliances, toys, all were set to rise sharply in price within weeks. Inflation was no longer a forecast. It was happening. Manufacturers then followed with their own warnings. Ford said the tariffs would add thousands of dollars to the cost of each vehicle it produces. General Motors warned of supply chain disruptions and potential shutdowns. Apple signaled likely price increases. Boeing warned of delivery delays. Caterpillar warned of job losses. These were not projections or worst-case scenarios. These were day-one consequences of policy decisions already in force. Credit rating agencies reacted with equal urgency. Moody's, S&P, and Fitch all raised concerns about the United States' creditworthiness. Borrowing costs began to rise. Debt servicing risks increased sharply. The prospect of a fiscal feedback loop, higher rates leading to higher deficits, leading to even higher rates, became a genuine concern rather than an abstract theory. International financial institutions added their voices. The International Monetary Fund issued an emergency statement warning that escalating trade tensions could trigger a sharp slowdown in global growth. The World Bank echoed that assessment. Recession risks rose rapidly across multiple regions. Domestically, however, the political incentives pointed firmly in the opposite direction. Trump's core supporters celebrated the confrontation. Conservative media framed the measures as long overdue strength and resolve. In this environment, compromise carries political risk, while escalation is rewarded. The same dynamic exists abroad. European leaders cannot appear weak. Chinese authorities cannot be seen to yield. Mexican leaders cannot accept public humiliation. This is precisely how trade disputes harden into full-scale trade wars. The first bankruptcy linked directly to the new tariffs soon followed. Thousands of small and medium-sized businesses became vulnerable almost overnight. Business models built on global supply chains were rendered unviable in a matter of hours. By the end of the day, global markets were down by trillions of dollars. Credit markets showed signs of strain. Long-standing alliances were visibly fracturing. Tensions between the White House and the Federal Reserve edged closer to open institutional conflict. Several scenarios now present themselves. A rapid de-escalation remains possible but unlikely. Mutual escalation appears the most probable path. A broader financial crisis cannot be ruled out, nor, in the longer term, can geopolitical escalation be dismissed entirely. None of these outcomes offer reassurance. The reality is simple. Trade wars produce no winners. China can withstand economic pain for longer than most democracies. Europe is increasingly determined to assert strategic independence. Mexico will not be bullied into compliance. American consumers, meanwhile, feel the effects first through higher prices, higher borrowing costs, and rising job insecurity. For ordinary households, the implications are immediate. Investment portfolios have already taken losses. Mortgage rates have risen. Imported goods are becoming more expensive. Layoffs are moving from risk to likelihood across manufacturing, retail, and technology. History offers a stark warning. In 1930, the Smoot-Hawley Tariff Act triggered retaliation, collapsed global trade, and deepened what became the Great Depression. Economists have studied that episode for nearly a century. The conclusion is unequivocal. Protectionism does not protect economies, it damages them. Political slogans cannot override supply chains, market forces, or comparative advantage. Global manufacturing systems built over decades cannot be dismantled by executive order without triggering disruption on a vast scale. Within hours of Trump's inauguration, the world responded. Not out of choice, but necessity. This is not negotiation, it is economic warfare. And in economic warfare, there are no victories, only varying degrees of loss. The next 72 hours will determine whether this episode becomes a short-lived shock or the opening chapter of a global economic crisis that reshapes the world order. Political incentives currently favor escalation. Markets have only begun to react. Brace for impact. The turbulence we have seen so far is unlikely to be the worst of it. China's response followed shortly thereafter. Officials announced countermeasures within 24 hours. These included plans to halt purchases of U.S. Treasury bonds, restrictions on rare earth exports, retaliatory tariffs on American agricultural goods, and threats to limit dollar-based transactions while seizing U.S. corporate assets operating in China. This was not a negotiating signal. It was a declaration of economic confrontation. The European Union soon followed suit. Emergency sessions were convened, counter-tariffs were prepared, formal complaints were lodged at the World Trade Organization. Coordination with China intensified, alongside renewed momentum toward deeper EU-China trade agreements. Measures targeting American technology firms were openly discussed. In a matter of hours, the foundations of the post-war transatlantic alliance showed visible signs of strain.